fraught. That's the word we use in the office for days like today when so much seems to be going wrong.
In this video, Jim Cramer critiques the Federal Reserve's shifting approach to inflation, arguing that the economy's surprising resilience reduces the likelihood of further rate cuts. Cramer prioritizes corporate earnings over monetary policy for stock performance and acknowledges the mixed earnings reports recently from Microsoft and Tesla, suggesting there is still potential for market growth. He also examines the U.S.-China competitive landscape, praising Meta while expressing concerns over Nvidia's amidst potential export bans and a growing Chinese tech sector. Lastly, Cramer encourages a broad market perspective and urges caution in investing, particularly regarding the volatile tech sector.
Let's break them down, because if this market feels like a minefield, it's a minefield of our own choosing. There are plenty of areas with clear paths if you're willing to look. First, let's take the Fed. Today, Jay Powell once again made it clear that he's looking at the data to figure out what to do next. Sure, a few months ago, they thought that the economy was slowing in an inordinate pace. They spoke about needing to be vigilant because they feared they would fall behind if the economy really took a header. But the economy didn't take a header. Instead, I think the Fed didn't and couldn't predict the burst of economic activity that came with the election of President Trump. You know, it's a little uncanny. It's kind of like a switch was flicked. The optimism came out of nowhere, but the business community was very happy about the election, and their optimism was palpable. Big change from how they felt under Biden. That's why the Fed chief told us today he can't stay as concerned about a slowdown. As he said today, we don't need to be in a hurry to do anything. Now, at another time, we'd be thrilled to hear that message. But there are still tons of investors betting that the Fed will keep cutting rates as the year goes on. They forget that the Fed's data dependent. And right now, the data says do nothing. They thought more rate cuts were inevitable. So then what do? They sell stocks like crazy when they don't hear that the Fed's in a hurry. Remember my view, as long as the Fed's willing to cut if the Fed economy deteriorates, we're in a good moment. We have good earnings, and for that matter, matters more than monetary policy to me. Good earnings makes stocks go higher. Good profits combined with a benign Fed equal higher stock prices. Optimistic, glass half full. You know, I hate those press conferences after the Fed speaks. I mean, that's because the press has to ask the most provocative questions, mostly referencing President Trump's statements about the need to get interest rates down. At one point, I had a job like these reporters. I was early in my career, penniless, living in the back of my car. I always tried to make some sort of wave, something that so threw off the person leading the press conference that I knew my pathetic bosses would be thrilled. They always were. I, as they say, no longer pay for dinner. I don't need to make a splash or even a ripple. I just want to tell the story. And the story is the Fed's going to have our backs if things get weak, not going to be intimidated by the president. If the economy gets too strong, Fed won't help us. I see inflation potentially coming down because I think housing costs are coming down, supermarkets getting slightly better, oil's pulling back, auto prices going lower. And that's the data. I like the data. Here's what the press and many investors don't seem to realize. The delusional people want more rate cuts, but the Fed is only willing to give us that in a situation when the economy is falling apart. Fortunately, we're not in that situation. Optimistic. Think about how strong some sectors are. When the Fed slows its rate cuts, that's nirvana for banks. That's where they make the most money. See those stocks? Healthcare's been lagging from far behind. Now I think it's playing catch-up. Travel and leisure. I mean, what a bull market. No top. Which leaves the Mag 7. We always talk about these stocks as if they're invincible. As someone who shared in the creation of the term Mag 7, all I can say is, remember, the Eli Wallach's goons gunned down a bunch of them. Maybe we're near the end of the movie, and some of the good guys, James Coburn, maybe Robert Vaughn, have met their demise. How about the ones that reported tonight? Microsoft delivered a strong overall quarter, but the most closely watched figure is the constant currency revenue growth for Azure, their cloud infrastructure business. That missed so slightly. In truth, the success of the quarter will be determined by Microsoft's guidance, and that should come at the end of the earnings call, which is going on right now. I ain't cuffing it. Anyone trading a stock before that's putting the cart before the horse. As for Tesla, as long as Elon Musk is behind the driver's seat, I want to own the stock. He put up soft numbers tonight, but a terrific forecast for 2025. I'll go with that. Musk delivers. Moreover, he makes cars that could become our nation's de facto autonomous vehicle king if his close associate, the President of the United States, opens the federal interstate highway system to Tesla, if only to keep us competitive with China. The best report of the night was easily Meta Platforms, which delivered a colossal top and bottom line beat, tremendous free cash flow. Meta also offered a conservative outlook, lower than expected revenue for the current quarter, but after a quick pullback, investors ignored the guidance, which you have to do, and sent the stock higher in after-hours trading. After seeing what Zuckerberg did in that latest quarter, I think it's right to look past any conservative forecast. Which brings me back to the dilemma of Nvidia. Right now, we're trying to figure out what's really going on. Is the president going to take action against China, banning the export of Nvidia chips? So far, that seems to have created a mother necessity situation where Chinese companies say they've developed software that gets much more out of a single chip. So we have the political pressure and earnings pressure from the possibility that companies won't need as many expensive Nvidia chips if Chinese software gets more out of them than ours. We don't know what's worth. We can't figure out the price-to-earnings multiple. So many are heading for the hills. The only problem, we're going to step on a landmine between here and the hills. I say that Nvidia and Apple are becoming two of the most hard stocks to own. I myself regard this as one of those moments Thomas Paine talked about. These are indeed the times that try men's souls for both Nvidia and Apple shareholders. Is there a crisis at Apple? No, it's just facing a belief that in earnings, and more important, its forecast will give tomorrow night. It will be rough. It'll be actually terrible. Sell. Nvidia, I fear that order cancellations are trying to be priced into the stock. I don't know if it's done yet. When it does, the stock's a buy. I just can't divine that level without more information. I'm not even going to make a claim that I have it. I'd say they're not so magnificent 6, maybe the OK 5. Why don't we wait and see? But the bottom line, if you stop focusing exclusively on big tech, then we got a great market going. And if all you care about is the Mag 7, remember the movie. Make sure you have the survivors and trust that more make it out of the village than we saw in the original.